Good afternoon, everyone. Andy Moss here, tradingadventures.com with your midweek market update. And last week we looked at a short-term shift in character as we started to see markets dipping below the 5-day moving averages and making lower lows and lower highs. And that sequence has continued. It's been cut a little deeper now. And as always, our earliest indication is the slope and direction of the 5-day moving average and where price is relative to that. So hopefully no one was caught off guard by this move. We saw the signs showing up. We mentioned and reviewed the fact that long swing setups were getting fewer and further between, and it was a time to just go a little slower and be more cautious. And so no surprise here to see the market continue to sell off for the time being. And the roadmap chart continues to paint the picture or point the way. Lower lows, lower highs, below declining 5-day moving average. And that doesn't show any indication of changing at this time. So looking at the futures version of that, we are down to this anchor off the, bear with me here just a minute while I zoom the chart out a little bit. This is the anchor off the March 30, not quite the March 31st low. This was April 7th. Same for the Qs, the NASDAQ 100 futures, I should say. So not really looking like much support yet. A little bit of a bounce there the first time around, but not getting any support here so far this time around. And Q's futures just still a little bit above. So it's a cautious situation here. We want to keep monitoring. Going over to our daily charts, looking at SPYs now well below the 8 and 21 day moving average. This was the last midweek update here. This is a week ago, and we mentioned that it was just barely starting to turn over, and it's been pretty steadily down since then. Here's the rising 50-day moving average coming up at around $719 on SPYs, and I'm not sure why that anchor's there. Let's just move this to the March 31st low, and below that 710 would be an area of interest, which has some consolidating price action back here to consider. Also noted the DeMark 9 sell setup here on this day a week ago, and that turned out to be a good indication. You all should know this is a signal that I do pay attention to. It's not infallible, it's not always perfect, but it does line up pretty well with some short-term reversals, and this happens to be a particularly good example. So from the upper Bollinger Band down to the lower Bollinger Band, which is curling lower, the upper band's here flattening out, and like the SPYs, we have the rising 50-day down here around 676, and that anchored VWAP from the lows at 667. So would not be surprised to see prices eventually test or maybe even undercut this level before this move is over. And just for reference, from the high a week ago to the lows of yesterday, that's down 8.3%. So not yet in what the media likes to label as correction territory. It's still a pretty mild pullback, all things being considered, and especially relative to the scope of this rise since March 31st. Dow, a little more pronounced selling here, a little quicker selling. It took a couple more days before it made its recent high, and also down now below the 8 and 21 day. 50-day down here, which coincides with this level of price action that goes back for many, many months. So that's an area to, I won't say target, but that's an area to be mindful of to the downside for DIA. That's around 490 to 495. And finally, for the indices, IWM is grinding lower. Big ranges here yesterday, and here are your levels to watch. This, we always remind, it's more erratic, it's choppier, it moves around a lot more, it's a good bit more squirrely. So the thing that still the primary theme, I think, here is the inability to get and stay above this extension level, and so that's going to be another level of interest if and when things start going back up. But right now, the levels to watch are probably, most importantly, the 50-day at 276 and that anchored VWAP from the March 31st lows down to 273. Bitcoin, a little bit of consolidating action, but this is a bearish consolidation pattern as all of the moving averages are moving sharply lower, and no sign of relief there for Bitcoin. The rest of the world, we'll look at some of these very briefly, coming back down. China down, bonds chopping around, but still in a primary downtrend. Same with TLT, and crude oil is no directional solution there yet. It's still below the 821 50-day moving averages, but not really going anywhere. Gold, however, this has been notable recently, is gold is below its 200-day moving average for the first time in quite a long time. I don't know the day count or the year count, but it's been a long time since we've seen gold break down like this. And silver, which was holding up a little better, is also below its 200-day moving average. So seeing some risk off action across the board there. Looking at, here's growth versus value, or excuse me, this is the growth index all the way already down to its 50-day moving average. Value holding up a bit better, potentially a defensive signal there. Here is the consumer discretionary breaking out of this consolidate. It's a little sloppy, but you could call this a consolidation range here. And after this failed break higher, it is now threatening to break down out of that range. So that's not particularly something we want to see for the continued health of a bull market, whereas staples going up. So these are the things that we look at every week, week in and week out. These can be preliminary indications of risk on behavior or risk off behavior, risk appetite, whatever you want to call it. And then, of course, we like to look at these mostly on the weekly charts. I don't check these on the daily too much, but just to give you the relative relationship there. Here we see value very clearly the stronger asset, staples very clearly the stronger asset. And looking here also at SOXX, which has been a market leader. Like the Qs last week, it had a DeMark 9 sell, and it's down, what is this, 12 or 13% at today's close, and more than 15% at yesterday's lows. So the AI trade, the semiconductor trade, all of that cooling off a bit. And the charts, you're getting the idea here. Everything's under a bit of pressure. Some things are holding up better than others. There's the biotechs. Let's look at healthcare while we talk about defensive sectors. Generally speaking, people like to position in healthcare if things are not quite as rosy or the risk appetite is not quite as strong, and that's what we're seeing there. So software, really bad failure off of this move, and right this cluster of VWAPs in the 50-day around 88, mid 88s, really need to see that hold or things could get pretty nasty for software. Mag 7 is just really ugly here, and this chart's ugly too. I got way too much stuff on this chart, but you get the idea. It's broken down. It's lost all of its recent momentum. This is let's just see, that's a 30% move, and we're down, nearing the halfway point. That would be right in here. So you definitely don't want to see the Mag 7 give up more than 50% of this recent rise. That would be not an ugly, pretty picture. Financials trying to go, but just still really stuck below this 200-day moving average, declining 200-day moving average. And energy, of course, looks about like oil, choppy and no real direction. Apple, which was holding the Mag 7 higher, here is a week ago. We mentioned it was a leader and holding up well relative to the others. It's now below its 8 and 21 day, nearing the 50-day, much like the indices there. Amazon, really ugly action, looking at its 200-day moving average down there at 232. Google is losing its 50-day. Maybe some support in here at 351. Or actually, I'm not sure why that got on that candle. Let's move it down here and get a better picture. It's testing this anchor off the March 31st low right now. So closed below that today. And if that doesn't hold, we've got a lot of room down into 338s and into the 314, 315 range for the next potential support there. Google, Meta, not looking good, breaking lower. Again, a bit of a failed breakout here and now breaking down out of this consolidation range. And Microsoft, we talked about that last week, and it has given up more of the move, and it just looks like abject failure here on this slight attempt over the declining 200-day moving average. NVIDIA is looking pretty ugly, and finally Tesla down here. So you get the picture. All of the large cap charts, the indices, a lot of the individual sectors, with the exception of the more defensive areas, they just don't look too good. Now that doesn't mean they're going to crash and go down further, But again, we come back to this over and over again. The early indication is always going to be the roadmap chart. This is a 30-minute time frame of the four major indices and lower lows and lower highs below declining 5-day moving average. That tells us every time, slow down, be more cautious. We don't want to get too active on new long swing trade positions until that changes. So that's what we're going to be watching for first. And in the meantime, just take it slow. Know what you own, manage your stops, and don't try to be a hero and catch things as they're falling. Wait for that resumption of strength. A quick housekeeping note, there will not be a weekly charts video this Saturday. My oldest son is getting married. We're going to have a celebration and a good time and a little bit of a breather away from the markets. So you've watched them enough. If you've been around here for a little while, pull them up on your own. Take a look at the weekly candles, the moving averages, the 10-week and the 40-week. Throw some anchored VWAPs on there in the proper places, and see what you think. And then we'll be back to update and take a further look early next week. And if you have questions about your charts or whatever, drop them in the chat, drop them in the comments, or shoot a message here, and we'll pick it up when we get back.